Reserve Bank of India expectedly within the next few days will put out the draft guidelines for foreign banks' presence in India. Should we expect that StanChart may ultimately move to the wholly owned subsidiary model when the guidelines are clear?
So let us see the guidelines, George. No, on a serious note, I think the fact that the Reserve Bank has put out and taken the step of publishing a model which allows the foreign banks to participate, in a more deeper manner than before. That's a great step. No debate about that. I think it's a significant step and we've been asking for it for a long time. The guidelines were put out, which we have responded to. There are many parts to those guidelines which will help us grow better, and those which will hurt us, if we were to subsidize. So we'll have to evaluate all of those, especially when you look at the final outcome of the guidelines and see on balance what is consistent with our business strategy, and then take a decision to do that. But for Standard Chartered, India is a key market, and we will therefore look at it very closely. Because we want to use every opportunity that is feasible for us to grow faster. So this could be one of those, but we cannot take the decision till we don't see the final guidelines.
Now, one of the reservations that a number of foreign banks have is the capital gains tax angle, where if you transfer the branch assets into a newly created entity, which will be the WOS, you stand to pay quite a bit of money as a one-off. Do you believe that can potentially be a deal breaker for you?
It could. It could. The way the current capital gains taxes are written up, could be a very large amount, because you'll have to pay capital gains tax on the transfer of your entire assets from one entity to another. We have represented as part of our response to the draft guidelines. We understand the industry has responded and represented in a similar manner, and our conversations with the Reserve Bank suggest that they understand this issue as being a core material issue, which will discourage banks wanting to convert. So when the final guidelines come out, we are quite optimistic that they will come out with the solution to this, worked out with the Revenue Department, with Ministry of Finance, the Income Tax Department, which will allow some kind of a one-time relief and make this neutral to the issue of change of legal structure, is not kind of impacted by a financial charge in any manner. So that's what we are working towards. If it doesn't happen, if it's substantial, which is what our back of the envelope calculation suggests, it would, for us as Standard Chartered, would be very difficult for us to then convert and pay those charges.
Sure. But even assuming that there is no relaxation made and the capital gains tax is maintained at the level that it is right now, when you look back at this money that you pay many years from now, would the benefit of having got greater access to the Indian market have been a far greater advantage, and this really have been a very small cost to pay?
Judge, the way the guidelines are, it is not as if the equation has got only one side to it. So there are obviously benefits of let's say easier branch licensing, because the guidelines talk about near national treatment in terms of new branch licensing. But there are also other implications to subsidiaries apart from the capital gains. And so even without the capital gains issue, the issues are in somewhat of a balance. Okay, so there are commitments to priority sector, there are commitments to inclusion, opening of branches in smaller towns, etc., which will all have to be built into the business model to be able to see, and all of these will have some amount of cost. In our view, having looked at it, the capital gains standalone is a significant chunk, which could actually tip the balance and make it less attractive.
Now, while there are advantages, and you did mention there could be disadvantages as well, one of them seemed to be the fact that the RBI is keen that when you do get additional licenses, they would prefer that you go into underbanked and unbanked areas. Now, for a foreign bank, which has a relatively higher cost structures than maybe some of the public sector banks and private banks, won't servicing these markets be a huge challenge?
See, George, the way we look at it is that if we've got to be big in the country, and we've got to be a big bank in the country, which is our aspiration, we will have to participate in the national agenda. I don't think we have a choice, and in some senses, it's right. I mean, it is right for the regulator and the policymakers to expect foreign banks, if they want to participate like a local bank, to participate in the national agenda as well. So we are mentally prepared. We recognize that it is not our core strength. We do not have today the skills of being able to go into rural areas and small areas and build businesses there. So it's a skill we'll have to develop. We'll have to work at to build out a business model which makes it viable for us to be able to build out that business. So if we do decide to, and if this is a condition we have to meet, we will invest in the requisite infrastructure, people, talent to make sure that we do build that out.
Now, with this whole debate about StanChart maybe likely moving into a WOS model, there's been some amount of concern among IDR holders who've bought into IDR simply or in large part because of the India story of StanChart. Now, while the WOS would of course be 100% subsidiary of the parent, and there really is no reason to worry, would you give IDR holders the option to exit from the holding that they have?
Yeah, as you started, the question is still hypothetical because we are still to make up our decision whether we will operate as a subsidiary or not. And as I said earlier, that is subject to what the final guidelines come out and how we then view it with our business strategy and so on. But to carry on with your question, to say hypothetically, if we did subsidiarize, does it impact the holder of the IDR in India? And the answer to that is no, because if there is a wholly owned subsidiary that we operate through, it will be wholly owned by the PLC, SCB PLC, the shares of which the Indian shareholder as the IDR holder holds, and the full financial accounts, including profits of the 100% owned wholly subsidiary, will get aggregated into the parent accounts. So to that extent, it will have no impact, no financial impact to the Indian IDR holder. I want to also add that actually even today, as you speak, the almost half the group's revenues and profits comes from subsidiary operations in other countries. So there is a way of not a way. I mean, it does get aggregated to the PLC, and the shareholder really buys into the whole story. So whether we form a subsidiary or we operate as a branch, I don't think the IDR holder is going to be impacted anymore.
Okay, thanks.
Thank you. Thanks, George.